Hello. Good morning, everyone. How are you today? Okay. So tomorrow is the test. How's your preparation? So no problem so far, lah. Correct? What about you? You okay now? Okay. Put on your camera. So today we cover a new topic, yeah? Inventory. Now, so before we proceed, do you have any problem with the trade receivable? No problem, huh? So should be okay. Okay, in case you have problem, use the WhatsApp, just I mean, put your question there and then I will reply to you immediately. Just hang on. Let me do the recording first. No? You can? Correct? Still cannot? Am I lagging? Can you hear my voice or not?
Yes, can.
Clear?
Yeah, the voice clear, but your cam not working.
What do you mean? My cam not working?
Yeah.
Or your cam?
No. Your cam a bit laggy.
A bit lagging, huh? Okay, never mind. As long as you can hear me properly, that's the main important thing. Okay, inventory. So inventory, as you know, these are all the stock. Yeah, the stock that the business needs in their operation. So this is essential, and we have to know how do we do the recording. Okay, how do we record? So we're gonna learn today. Is it better now, Kelvin?
Yeah, okay.
Okay, all right. I'll share my screen. Too heavy, is it? Because I'm doing the recording and sharing my screen and also my cam. Do you think so, Kelvin? Is that the cost?
What?
You see now, I can't share your screen. Sorry, an error has occurred when screen sharing.
Oh,
I try again. Oh, I lost my connection. So my recording loss. Okay, let me try again. Okay. Okay. So the first thing that we need to understand is the definition, what is inventory? And then the second thing is accounting for inventory. Accounting for inventory is referring to the process of recording. Okay. And then value of inventory. So inventory, as you know, consists of different grade, different prices. So we're going to learn how to value the inventory. And at the same time, we are observing the accounting concept that is to be prudence, isn't it? So as inventory is an asset, so we do not want to overvalue the inventory, yeah, the inventory that is in stock. So because inventory is an asset, isn't it? And then how do we determine the quantity of inventory? Then later we have to understand how to do the recording inventory in the ledger, meaning using the ledger T account. And we have inventory adjustment as well, because some of the inventory that is being delivered to the customer, even though it's been delivered, but the ownership the ownership of the inventory is still belong to the seller, of which this is on consignment basis. So we have to do inventory adjustment. So the business entity, they they may be in two position, as a seller or as a buyer. So meaning if they are the seller, so they have to add all the inventory that is being delivered to customer. But if if the business entity is the buyer, then they have to exclude the inventory, because during the inventory count, they have included those good that is on consignment basis. So that is why at the end of the year, we have to do inventory adjustment after consideration of all these good on consignment basis. And then we have to calculate the gross profit using net profit margin and markup method. So these are the two gross profit calculation that we're going to use: profit margin and markup method. Profit margin, okay, with the assumption the selling price is 100%. Oh, sorry. The selling price is 100%. So meaning if we know the profit margin, so you just minus 100% minus 20%. Let's say the profit margin is 20%. So the cost of good will be 80%. Whereas markup, okay, markup will be with the assumption the cost of goods sold will be 100%. Okay, later then you will understand. Now, what is inventory? Okay, what is inventory? So this all depends on the nature of the business. Most trading and manufacturing enterprises will hold several categories of inventory as follows. So trading enterprises, meaning they buy and they sell. And then manufacturing enterprises, they buy raw material, they process the raw material and become finished good, then they sell it. Okay, so those companies that we are referring with, yeah. So trading and manufacturing enterprises. So these are the possible inventory that they would have in their business entity. Okay, one is good for resale. So good for resale is referring to the item. Okay, they buy and they sell. Okay, for trading purposes. Okay, excluding the good that is they buy and use. Different, huh? So this is good for resale. And then finished good is the same thing, good for resale, but then this finished good is where the company or the business entity are in manufacturing industry, where they buy the raw material, they process the raw material, become finished good. And also the manufacturing company, okay, at the end of the accounting period, okay, let's say the accounting period the same as calendar year. So let's say at the end of 31st of December, some of the raw material that is in process, okay, which we call it work in progress, meaning still in the process, but only up to 80% or up to any percentage, as long as it is not 100% completed. We call it work in progress. Yeah, work in progress, which is partly finished good, still being manufactured. And then the other one is raw material, bahan mentah, meaning these are the item that is used by the manufacturing company to be processed, to be used in their manufacturing processes. So component purchases for manufacturing processes. Okay. And the last one is consumable store. Consumable store, meaning item that can be used, yeah, in the factory or in the trading in order to upkeep the machine or to maintain the machine or to maintain the building, the business building. Yeah? So let's say we have lubricant. Okay, lubricant is for servicing of the machine, cleaning material, okay, to ensure the building or the shop, okay, always clean. Spare part used in manufacturing and maintenance. So probably we have spare part like screw, okay, the lights, yeah. So in case one of the lights burn, so they can be replaced with using the spare part. So those kind of item will be called as consumable store. So these are the possible inventory that we have for trading and manufacturing company. Okay, good for reselling, finished good, work in progress, raw material, and consumable store. Now, we have accounting for inventory, meaning proper procedure. How do we record for inventory? Okay, but before we go further, so we need to know why do we need to know the value of the inventory? Why? Okay, the reason being, okay, because inventory is asset and they are under category of current asset, which the balance of this asset is changing from time to time in a very short period because they are being, taken and sell it to the customer, or taken and being consumed, taken and being processed. So these are under category of current asset. So when we close the account at the end of the period, so we need the closing inventory value. Okay, why? For both, yeah, not only for statement profit or loss, that is to calculate the profit, but it also be needed in statement of financial position, which we have to present under current asset of the financial position of the business. Okay, so that is why we need the value of inventory in order to uh, construct our statement profit or loss and to construct the statement of financial position. Okay, that is why the value of inventory is important. Now, what would be the effect of inventory valuation on gross profit? So this one is we are explaining, okay, why we cannot overstate, why we have to observe prudence concept. We do not overstate the value of the asset, but asset and revenue should not be overvalued. That is prudent concept. And then liability and losses should not be understated. That is the concept of prudence concept, which is like this one, inventory. We cannot overvalue the inventory. Why? So this is because of this effect. The value of closing inventory will have an impact on the gross profit and as well as the net profit of the period, shown what we have in this example. You see, this is the trading account, part of the statement profit or loss, where we preparing in a presentation form. So we have two columns, okay? So two column on value, that is for adjustment, and then the net will be put on the second column. Okay, sales will be on the second column. Cost of goods sold will be on the first column. So we have to do the, what do you call it, the main formula for cost of goods sold, opening inventory plus purchases less closing inventory. Okay, so this is where we need the value of the closing inventory, that is less closing inventory. Then as a result of this amount, if the value of the closing inventory, okay, we take the higher amount, okay, what will happen to the cost of goods sold? The cost of goods sold become lower, isn't it? Now, if the cost of goods sold become lower, when we minus with sales, the gross profit is higher. And resulting gross profit less with expenses, the net profit also higher. Okay? But if we use lower closing inventory, what happened to our cost of goods sold? Cost of goods sold will be higher. So as resulting from higher cost of goods sold, your profit, gross profit, will be lower. So lower gross profit, less with expenses, you have lower net profit. So that is the effect. So if we overstate our closing inventory, what happened? We overstate our net profit, of which that overstating net profit, the increase of the net profit, is not because we sell more, but just because we use higher value of the closing inventory. So it doesn't give you the true profit, isn't it? So it not fair. It is not fair because if you presented higher gross profit, not because you are improving, the business is improving, but it's just that you have used the overstated value. So you are going to be taxed by the government with overstated tax. You are overpaid the tax. So prudence concept is guiding us. So we should, okay, we should not overstate our uh, closing inventory because of this effect. so that we have a lower net profit. So at least when we pay the tax also, we are not being taxed overtaxed. Okay. So from the example above, we can see that closing inventory high, cost of goods sold low. That is the effect. So you must understand the effect. If because we minus, so that's why cost of goods sold become lower. So as lower cost of goods sold, it will cause the profit to be higher. But if the closing inventory is lower, your cost of goods sold will be is higher, then that causes the profit to be low. So a higher closing value will result in high gross profit and as well as net profit, and vice versa. So far, are you okay? Can you understand the effect? Because of the formula, normally opening inventory plus purchases less closing inventory. Now, the next one is value of inventory. So just now we were talking about the effect. Okay, we need first thing is why we need to know the value of inventory. Okay, because we need this value in your statement. In your financial statement profit or loss, and statement of financial position, and we need to understand the effect. Okay, because in the formula, okay, opening inventory plus purchases less closing inventory. So if we use higher, so it will cost the gross profit together with the net profit, high net profit. Yeah. And the third one, the value of inventory is basically the result of the value uh, times unit and the quantity of the inventory shown below. So this is the value, okay, equal to value per unit times quantity. So normally you will be given like 5 ringgit 50 cent per unit. So if you bought 1,000 units, so 1,000 unit times 5 ringgit 50 cent. Okay, that will be the value of inventory. Now, so basically when we are accounting for inventory, so we ask 3 questions. So meaning in recording of inventory, so there are 3 issues that we need to consider. So the first issue that we need to consider is about the value of the inventory. And then after that, how do we manage to get an accurate quantity? Then later, we need to know how do we record in the ledger. So these are the 3 issues that we need to address when come to inventory. First thing, we have to value the inventory. Now, how do we value in the inventory in the accounting record? So we have the inventory valuation rules that is in line with the prudence concept. Okay, so which is LCM. So LCM stand for lower of cost and market value. Okay, that is LCM rules. Lower of cost and market value. What does it mean? Meaning we're gonna have 2 value for the inventory. One is on cost. So the cost we are talking about the price that we paid to the supplier. And then market value is an estimated value for the current market price. So you are not expected to determine how much is the market value, but you'll be given. So compare them. So which one is lower? Okay, which one is lower? So the lower one will be selected. Okay, so this is in line with prudence concept. So inventory should be value at the lower of cost and net realizable value. So market value, you have to consider the net realizable value as well. Okay, meaning you compare, okay, the selling price with costs. Yeah, you charge again costs. That is in order to make the item saleable. So sales price you minus with the cost, expected cost, you will get net realizable value. So same thing with the market value lah. Yeah. So this is to be, we extend further in order to get uh, more accurate market price. Okay. So comparing the cost, that is the historical purchase price from the this one, we are referring with this from the supplier of the inventory, and compare with NRV of the inventory. Okay. Choose the lower of the two. Okay, no adjustment. So we take for cost, no adjustment. But for net realizable value, we have to do adjustment. Let's say if they have damaged good, okay, so we have to process that goods in order to make it sellable. So we have to adjust the value to net realizable value. So we minus lah. So this is how we minus. Okay, net realizable value, the expected selling price, that is the market value, less any cost expected to be incurred in getting the inventory ready for sales. Okay, that is a formula. So you'll be given normally NRV immediately, or they just give you this market price and the cost to make it sellable. So you just minus lah, then you get net realizable value. Then compare with the cost. Okay, whichever is lower, then you times with this one lah. Value per unit is selected. If it's NRV, then this will be NRV value per unit times quantity. If it's cost lower, then cost per unit times quantity. Now, this is the reason why we choose the lower, like what I've explained to you, okay, in line with prudence concept. State the asset should not be overstated. So, because that's why we take the lower one. If we take the higher one, we are overstating. So that's why we choose the lower. Similarly, the prudence concept also require that any anticipated losses should be fully written off and profit should not be recognized until there is reasonable degree of assurance that they have been earned. Okay, so meaning why, okay, instead of, because you have anticipated losses here. Let's say the cost is 10. You bought it 10 ringgit. But then when you consider the estimated selling value because of the economic situation, okay, and the processing, so you have NRV 8 ringgit per unit. So meaning you have a loss of 2 ringgit, expected loss, isn't it? Because you haven't sold it. Now you want to value because it's still in inventory. So you want to value the inventory. So this is what we call anticipated losses. The anticipated losses is 2 ringgit. Okay, we write off immediately. Yeah, if we anticipate mean expecting there will be loss in value. So we write it off, recognize it. So meaning by recognizing it in a lower value, that is actually anticipating the losses. Okay. So when there is a disagreement over a particular amount, okay, meaning we have two amount and we subjective judgment was made. So which one do we decide? We select the amount that give a lower profit. Okay. Otherwise, if we selected, okay, that is overstating the profit, higher profit, then we are actually against the prudence concept. Okay. So a lower valuation will result in a lower closing inventory amount and a lower profit amount. So hence the prudence concept is followed. So to be safe, okay, always take the price that is giving a lower profit. So meaning when you do the value, take the lower value. So this is the example that we have. An item of inventory was purchased at a cost of 5,000 previously. Its current selling price, the market value, is 7,000. However, 250 selling and distribution expenses will have to be incurred in order to sell the item. Therefore, the NRV is 7,000 minus 250, so 6,750. So this is the first scenario, meaning it illustrates at that time, that machine, what is this? Is this machine? Sorry, let's say this is probably they are selling product machine because 7,000. The price is very, I mean, the cost is 5,000, so it could be machine So let's say they buy and sell the machine, and at that time, okay, they bought 5,000, and during that time, if they sell it now, they can sell it at 7,000. But then before they can sell at 7,000, so they need to do advertisement. So they group that cost as selling and distribution expenses. So meaning the NRV, okay, we use the formula that is the market price 7,000 less 250. So this is net realizable value. So comparing the cost 5,000 and the NRV, so we choose the cost as the value, yeah, because this has not been sold yet, so this is still in the stock, so we have to value the inventory. So the value will be 5,000, which is lower. So choose the 5,000 as the value of the inventory level. Now, scenario two, okay, probably the year after, and this good still not being sold yet, but and at that time, the demand, okay, because of economic changes, the demand for this machine dropped, yeah, and at that time, the expected selling price now is no longer 7,000, but dropped to 4,005. So the NRV resulting from this drop of price, okay, with the existing selling and distribution costs, okay, remain the same, 250. So NRV now is 4,500 minus 250. So we can only sell it 4,250. But then when they bought, the cost is 5,000, isn't it? So meaning if we value to 4,250, we are anticipating there is a loss, isn't it? So about 750. So therefore, the NRV will be the value of the inventory item. Okay, because according to prudence concept, the anticipated losses should be written off immediately. So how do we write it off? So don't worry. So just consider or use the NRV as the value of inventory. You are writing it off already. So that is why instead of using the cost 5,000, we value the inventory to 4,250. Okay, so 4,250. This will result in an anticipated losses 750 being written off in inventory. Okay. So prudence concept requires the business to write off the anticipated losses of 750. So by using the NRV for closing inventory 4,250 in cost of goods sold, the gross profit amount is already been reduced. Yeah, is already been this anticipated losses is already been recognized. That is reducing the cost of sales by 750. Okay, lower closing inventory make the profit lower by 750. And show the lower inventory amount in the SOFP, Statement of Financial Position. So this balance sheet is an old term. Okay, by using NRV for closing inventory in the current asset. So we have observed the prudence concept. That is, we write it off, the anticipated losses, by using the value of the inventory, okay, NRV, and by stating in the SOFP under current asset closing inventory of 4,250. Okay, so meaning we already have the double entry. Yeah, the double entry is we have credited the inventory and we have debited in the cost of sales. Right? So that is a double entry actually. So by using prudence concept. Now, can you understand the first illustration?
Okay.
Okay. Now, example two. Just now was single inventory, but what happen if you have variety type of inventory? Okay, just now single, one item only. If you have many inventory item, let's say you have a grade A, grade B, grade C, grade D, grade E, okay, and you see you have individual costs for each of the inventory item. So A 81, B 42, C 129, and D 87, and E 61. And the total is 400. And then net realizable value. So we have 96 for A, and B 24, and C 165, D 120, E 55. In total is 460. So common mistake made by your senior previously. They take the total and they do the comparison, 400 and 460, so they take 400. So this is the value of inventory. So that is wrong. You have to take individual. Yeah, you have to do the comparison individual item. So like 81 and 96, take the lower one, 81. 42 and 24, take 24. C 129 and 165, so take 129. 87 and 120, take 87. 61 and 55, take 55. Okay, so meaning to say, what happened here? Look at the blue color. Is this blue? Blue, huh? I don't know. I'm color blinded.
Yeah, blue.
Blue, huh? Okay. So you see, we this is anticipated losses. We bought for 42 ringgit, but we value at 24. So we have loss, isn't it? That is about 18 ringgit. And this one, we bought for 61, but now we value 55. We have a loss of about 6 ringgit. So this is what we call anticipated losses. So by using this value, okay, that is 81 plus 24 plus 129 plus 87 plus 55, that will be the value of inventory item using lower cost market value rules. Okay, so that is we written off immediately. By performing the LCM rule for each item separately, the prudence valuation of 376 is derived. So meaning when you plus all this, you get 376. Okay. So, and this value should be appearing in the statement of financial position instead of 400 at cost or 460 at NRV. So use 376. Okay. Prudence concept, we need to use 376. All right. Any problem with this?
Uh,
Okay. Now, method to calculate costs. So now we have this because you see we are talking about costs here, costs, not NRV. So we have when we value the inventory, also the cost, you have a certain method. So we have a certain method to follow. So that is we have first in, first out, FIFO, and then WAC is weighted average cost. So this is the main things that we are learning today. Okay, how to do the first in, first out, and how to do the weighted average method, weighted average cost. Okay, so once we selected, so this is depending on what is the policy of the company. If they selected first in, first out, okay, so at the end of the calculation, you will have one value for the inventory and you compare with the net realizable value. Then you select which one is lower. If the first in, first out cost is lower, then use that as a value for the inventory and then you times with the quantity. Okay. So, but in the exam, you are required to prepare both. Okay. So you are expected to be able to draw what they call it bean card, stock ledger card. Stock ledger card. Huh? So there are two acceptable approaches to determine the cost of inventory. So each of which employ different assumption. Okay, mempunyai dua andaian yang berlainan. Yeah, the first one is first in will be the first out, meaning the assumption is when the first that came in, let's say if you have inventory, which is January and February. So January came in first, isn't it? So January stock will be used first. Okay, that is the meaning, first in, first out. So the definition, the cost or the value of the oldest inventory, because January is the oldest, isn't it? Is charged as cost of sales first, followed by the cost value of the newer inventory. Okay, hence the closing inventory are valued at the latest or most recent purchase cost. So you must understand this wording, meaning you use the oldest one. You use, let's say if you have January, uh, February until December. So now we are in December. So January until October you already consumed. So now leftover is the October, November, and December prices. So when you have, during the end of the year, you have an issue, okay, of the inventory. So you have to use the October first, isn't it? Because that is the oldest inventory. And it will be charged, the price of October will be charged in the cost of sales. So if November and December are not being sold yet, it becomes an inventory. So the cost or the value of the inventory, that is inventory already because we have not used it, isn't it? It will be using the newer prices. So that is the meaning of this wording. The cost value or the cost or the value of the oldest inventory is charged as cost of sales and followed by the cost of value of the newer inventory. Okay, so hence the closing inventory are valued at the latest or most recent purchase cost. Note, it is the cost of the oldest inventory that are charged as cost of sales first, followed by the newer cost. The oldest physical inventory item may not be the first to be sold, especially if the item are still identical. So the customer can choose whichever stock they prefer. Okay, this is the explanation. So this one is the assumption. I mean, the bracket here is the actual case, lah. Yeah, the actual what is happening. Okay, but just understand, yeah, that the value of the closing inventory meaning using the recent prices. The recent prices meaning the prices that is updated prices, lah. But the cost of sales will be using the old price. So if we are in an inflation time, you know inflation. Inflation means where all the prices of the item is increasing. Okay, like let's say you have January to December. So January different price, February different price, until December different price, but it is increasing, uptrend. Okay, let's say in January it was like 10 ringgit, and then after that increased to 11, 12 ringgit, 13 ringgit, 14, 15, 16, 20, and until 22 in December. So this is uptrend. This is inflation. So what happened? Meaning the closing inventory will be using the latest price, 22 ringgit. But when we charge to the cost of sales, we charge, okay, based on the old price, which is cheaper, isn't it? Okay, like just now I was saying, we have used until up to October. So you have used 11 ringgit, 12 ringgit, 13 ringgit until 20 ringgit, isn't it? So your stock, okay, will be 21 and 22 ringgit. So that is first in, first out. We use the oldest inventory and charge as cost of sales. Okay, and the closing inventory are valued at the latest, the most recent purchase cost. Now, what about weighted average? Weighted average, it requires the combination of the unit cost of the inventory by totaling the cost of existing inventory and the cost of new inventory purchase, then divide by the total unit of inventory held after the new purchase to get the average cost. Now, the most important thing is average cost. Average cost meaning we take average. So we have the cost per unit and we have the quantity, isn't it? So meaning whenever we have a new inventory, so what we have to do, okay, you plus, okay, total combination of the unit cost of inventory by totaling the cost of the existing. Meaning if you have existing inventory, you plus with the cost of the new inventory purchase, then we average it out. Average it out by dividing, okay, the total unit of the inventory. Let's say the existing one we have 10 unit, and then the cost is 100 per unit, so we have 1,000 ringgit, isn't it? And the new one we have 5 unit, and the cost is 101. So 5 times 101, so 505, isn't it? So 505 you plus with 1,000. So we get a total, then divide with 15 unit. So that is averaging. Okay. So that is weighted average cost. So we're gonna learn how to do this recording. Okay. So let's see. This is the illustration number 1. A hardware trader which is spraying chemical for resale. So during the month, of September 2017, the following transaction took place. So we have few options. So we can record based on monthly basis, or we can record on yearly basis. So if it's this one is monthly basis. Okay. So you are given, yeah, the transaction normally in the exam also, or even in your tutorial, you will have, okay, opening balance, meaning this is your existing balance. So you have 10 units. And then the price per unit is 40 ringgit. And on the fourth, we have purchases. And purchase 18s with 44 ringgit. Okay. And then on the 6th, we have a sales. So 19. So meaning now we want to decide, because you have two prices, different prices here. So which price are we going to charge? The cost price, we are talking about cost price. We are not talking about selling price. So this one selling price, we don't, at this level, we ignore the selling price, because now we are preparing the cost ledger, yeah, the stock cost ledger. So we ignore the selling price. So we want to decide which, these are two different prices. So how much, which prices are we going to charge on the 9 that is being sold? So that's why we have first in, first out, and weighted average. Then after that, on the 15, okay, we bought another one, 16, and the prices is 48, much more higher. And on the 11, sorry, 18, we have a sales 11 tin. So again, we have to decide what is the cost of the 11 tin that we sell, because we have three prices in. Okay, when we sell this one, we have few left, isn't it? So we have to select. Then the last day, okay, we bought another 14s. So we want to decide how much is the leftover. So the leftover will be the inventory value, cost value. So that cost value, then we compare with NRV, so whichever is lower. This is the stage where we are applying the LCM. Okay. Now let's do the first in, first out. So required, calculate the cost of sales. Okay. You need to determine what are the things they need. The cost of sales. So cost of sales, meaning same meaning as cost of goods sold. Okay. For the month of September 2017, and the value of closing inventory based on first in, first out, weighted average valuation method. So there are two things that we need to determine. One is cost of sales, and the other one is closing inventory. Okay. The value, we are talking about value. We are not talking about quantity. But then we need all that information in order to get the value, because cost per unit you times with the quantity, isn't it? Okay, so the first thing is we are using the first in, first out. So this is in columnar form. So remember, what do you call this? This is what we call stock ledger card, because this is inventory, isn't it? So meaning stock ledger card. Or they call it bin card. Bin card, B-I-N, bin card. So they are the same, bin card. So you prepare in column form. So column form, so the first column is date column. The second column, good received column. The third column, good issued column. And the last column is balance column. Okay, so for easy to remember, so each of this column you have to divide into three sub column. Three. So same thing with the other second column and the third column. So normally I would symbolize it as Q, and then this one, the second one, P, and then this one, the third one, V. So easy for me to remember. I put QPV, QPV. But this one in your notes, they put as quantity at RM. So it depends on you. Do you want to use this or you want to use QPV? Is all acceptable. But for me to easy to remember is I use QPV. Q meaning stand for quantity, P meaning stand for price per unit, and V meaning the value, quantity times P. Do you get it? Now, can you look at the illustration that I have, explained to you the September 2017, and we'll do the recording. You look at this screen now. September the 1st, if you look at the transaction, we have opening balance 10 tins, 40 ringgit, 10 tins, 40 ringgit. Now, you need to understand each of this column. Good received column is stand for purchases. Okay, because when you purchase, you're receiving the quantity, isn't it? And then the middle part, the second column here, good issued column, stand for sales. Okay, so because issued, when you sell, you are issuing the quantity to the customer, isn't it? And the last column here stand for the balance. Okay, meaning like what we have in the transaction, the illustration number 1. Yeah? So opening balance. Opening balance is indicating to you this is the balance, opening balance. So opening balance, you don't record under purchases, you don't record under sales, but you record under balance column. So that is why, okay, we need to record 10 unit, 40 ringgit. Okay, 10 times 40, then you get 400. Okay, 400. Now, we have to record row by row so that because you will be able to identify which came in first and which came in later. Okay, you have to record individually on row by row. So the first row, when we have the opening balance, September the 1st, we record, yeah, in the balance column, not in the received or issued column. Then record 10 unit, 40 and 400. Okay, this A no need to write down. This is only for your understanding only. A no need to write. Now, so no more transaction on September the 1st. So we only have transaction on the 4th, isn't it? Now, if you look at the 4th, you have purchases, correct? So if you have purchases, so you need to rewrite the balance first. Rewrite the balance meaning you refer from September the 1st, you have 10, so write back 10. You have 40 ringgit per unit, write back 40. And then 400, you write back 400. So meaning on the 4th of September, you have occupied the first row, isn't it? So if you, for that particular date, you have purchases. So you only record the purchases on the second row. Okay, because we want to avoid confusion. So that's why we record on the second row. So when we record, since on the 4th we have purchases 18, so you record on the receive column. Record on the receive column, quantity 8, price per unit is 44. And then 8 times 44 is 352, correct? Then you update the balance. But update the balance, you cannot plus. So you must present it separately so that you know which one came in first and came in later. So 8, okay, quantity update, 8 quantity, the price per unit 44, and total 352. So done. we have recorded the purchases on the 4th. Then, if you look at the question, the next following transaction is sales. Now, if you have sales, okay, you don't have to rewrite the balance, but you refer the balance here. So you need to sell 9 unit, isn't it? So 9 unit. So you issue first in, first out. So you issue the first that came in. So which is stated here, okay, with the price of 40, isn't it? So available unit, you have 10, correct? So if you have available unit 10 unit, so you need to issue 9, okay? You can take from the first batch, okay? So issue all of it, 9, okay? And update your balance. So if you have 10 unit, you issue 9, so leftover is 1, isn't it? With the same cost price, 40, and your RM value, okay, will be 1 times 40 is 40 lah. Then, okay, write down the second batch, 8 unit, because no changes, isn't it? We did not use. So 8, 44, and with the same value, 352. Okay, done on the 6th. Now on 15, on the 15th, so the following transaction is purchases. So if it's purchases, like what I've said to you, if it's purchases, you have to rewrite, yeah, the available balance. So meaning you have to write the first one, 1, 40, and 40. And then 8, 44, 352. Then you start recording the purchases for on the 4th, on the 15th, okay, on the third row. The third row, okay, in the purchases column, in the receive column. So record 6 unit, price per unit 48, and total value 6 times 48 is 288. Then you update the balance. Update the balance. So you put 6, 48, 288. So as you can see, you have three batches. Huh? So one is with 40 ringgit per unit. The other one is 44 ringgit per unit and 48 per unit. So when you issue, you must issue the first that came in. Okay, but only available stock is 1, yeah? So meaning you have to look at the following transaction, that is on the 15th. Sorry, not on the 15th. On the 18th, you have a sales, isn't it? Now, if you look at the question, the sales is 11th. You need to issue 11th. So when you issue, you follow the sequence. You need to follow the first came in. So which is 1 only, 1 unit, 1 quantity. Okay, so issue them all 1, and then update your balance. So 0, isn't it? Because you already issued. And then not enough. So you still need 10. So you use a second batch. So you issue all the second batch, 8. And the price per unit is 44. Then record the value, 352. So the A and B, you don't have to record. This is only to show you they come from this batch. Okay. Then update your balance. So because you have issue all 8, so all this will be blank. Then still not enough. So far you have supplied 9 only. So you still need 2. How do you get 2? Okay, 11. The total sales is 11th. 11 minus 9, so left over is 2. So the 2, you get it from the last batch with the cost price 48. So you put 48 here, 2 times 48, 96. Okay, and then update your balance. If you have available 6, now you have issue 2, so you have left over 4. 6 minus 2, 4. And with the same cost price, 48, Okay, 4 times 48 is 192. Can you get it? So meaning to say, like just now, this is I was saying this is sales, isn't it? Sales column. So we don't use selling price here. Everything is on cost price. Okay, we record on cost price. We ignore the selling price at this level, right? Then the last transaction for the month of September is on 23rd. We have purchases. So since we have purchases, so first thing you have to rewrite the existing balance. So write down the first row, 4, and then price per unit 48 and 192 total. Then on the second row, then you record the purchases. So we have 4, 52, and 208. 4 times 52, 208. Then update your balance. So 4, 52, 208. Okay. So this is what the question wants. So that is the balance column is the closing inventory. So the balance value column, RM column, value column. So you need, because for the balance column, you keep updating. After one transaction, we update, isn't it? So therefore, for this closing inventory, you take the last row value. The last row value, which is existing, you have 192, and then you have the new purchase on 23rd, 208, you plus, okay, 0, 1, 9, 10, 0, 1, 3, 4. So 400, that is the value of your closing inventory, 400. Okay. But the question also wants the cost of sales. The cost of sales is actually the good issued here. Okay. Because this is sales column, isn't it? So good issued. Look at the value column. So this is the value column. Now for this one, you can add, yeah, from from the above row 360 plus 40 plus 352 plus 96, then you get 848. So this is representing the cost of sales or cost of goods sold, same meaning. Okay, why we can plus from from the row, I mean in the top column here, 360 plus, and the bottom column. Why? Because this one we did not update, like what we done in balance. So the balance we keep updating for every transaction. So that's why in order to determine the closing inventory, we have to take the last row. Yeah, the last row or the last transaction for the month. So 192 plus 208, 400. But for the issued column, okay, you can take, okay, the value column plus the value column that available. So we have one, 360, second one, 40, 352, 96. So altogether, 848. So this is cost of sales. So we already fulfill the question requirement. Now, additional information that we have is, in order for you to find the purchases amount, again, you can do the same thing like cost of sales, which is you take from the value column, 352 plus 288 plus 208 equivalent to 848 as purchases amount. Okay, why? Because this, okay, is not being like updated like what we have in the balance. So that's why we can take, okay, the value from the value column. So plus altogether, then you get the total purchases. Okay, so receive is for purchases amount. Issued is for cost of sales amount. So that is why we don't put the selling price here. Okay, instead, all these are the cost price. So that's why this is known as cost of sales. And for the inventory value, okay, you take the last row. Why the last row? Okay, because of the process of updating. Okay, so we have updated all this uh, column. Now that is first in, first out. Can you understand?
So if every time there's a different price, it's considered as a different batch.
Yeah,
Oh, and the one
like
the ABC.
how do we know? How do we know how many batches we have here? Okay, we have the existing one. We have two purchases, so three batches, isn't it? The existing is 40, okay, and then on the fourth 44, and on the 15th 48. So three batches here.
Okay,
Is that what you're
and
asking?
the yeah, and the ABC no need to write in the
Yeah,
stock card.
this one is for your reference, actually, for easy reference. Like, where does this 400 comes from? Okay, like this one 400. Where does it come from? Coming from the previous day. Yeah, that is on the first. And what about the B? Okay, here the B. Where does this B come from? Coming from the previous balance. Okay, easy reference only. So you
The
don't have to
AB,
write
the
it.
ABC is what?
Huh?
The
This one is for
ABC
easy reference only.
only reference only. Oh,
Yeah.
okay. Do we all still need to do? We also need to write the ABC, yeah,
No need, no need. If you understand, no need.
just to signal the number change on here.
Yeah. That is only giving you the indication where did this come from. Okay,
Okay.
Okay.
Farah, you okay?
Yeah.
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 All right. So I continue with weighted average, huh? Before we take a break. Now, weighted average, okay, meaning we have to divide the quantity. Sorry, we divide the value with quantity. Huh? So this one is much easier. So we are using the same column, okay? On the top, the first column is date, and then on the top of the date will be the method. You write down WAC, weighted average cost, like just now, first in, first out. On the top of the date, you write down first in, first out, okay? So, and the following column will be good received and good issued, followed by the last one is balance column. And each of the column, you will have sub column for Q and P and V. This one also QPV, QPV. Okay, this is known as bean card or stock ledger card. Now, for the opening balance, September the 1st, so we record, yeah, into the balance column only. So 10 unit existing, okay, with the price per unit, cost per unit 40, so total value 400. 10 times 40, 400. Okay, and then the next one is purchases on the fourth. If you look at the question, we have purchases 18s at 44 ringgit per unit. Okay, so you record under receive. You don't have to rewrite the balance. Huh? You don't have to rewrite the balance like the first in, first out, but you immediately record under the receive column. Yeah, 8 unit, price per unit 44, and then 352. So you can record even though in the same row. Yeah. So you don't have to select first row, second row, like the first in, first out. Okay. You record in the first row, 8 unit, 44, 352. Then update your balance by adding. Look back on the definition. Add with the existing. So meaning 10 unit add with 8, so 18. Okay, but the cost per unit we can't add. We can't add because we need to do the averaging. But the value, yes, you can. So 400, yeah, existing plus with the new purchase, so become 752. Now then you can get what is the price per unit, okay, by doing the averaging. So which is total value, this is total value 752 divide with quantity. So 752 divide with 18, how much? 752 divide by 18. Okay, you have to be consistent. If you take two decimal place, then you have to take two decimal place throughout the recording. Yeah, you have to be consistent. So meaning this one will be 48.777. So 7 is more than 5. So become 41.78. Okay. So this is the same row actually, but just because the formula was given here, total divide with RM per unit. Okay, so that's why the row is bigger. It should be in the same row lah. Yeah, can you understand what I'm saying?
Oh yeah.
Okay. Now on the 6th, if you look at the question, we have cells 19. So why I said easier? So you don't have to look at which one came in first, which one came in later. So you just immediately record it in the issued column, 9 unit, and use the average cost that we have recorded. We have calculated 41.78. So use that 41.78. So this one you must time lah. 9 times 41.78. Okay. So you have to be consistent. If you have used two decimal place, so you need to record two decimal place also. So this one 376.02. Okay, 376.02. Even though in the answer it is, they have do the approximation. So because we have used these two decimal place, so you have to be consistent lah. So you need to put, okay, write down in your notes. This one should be 376.02. Otherwise, if you give the wrong figure, marks will be deducted. For me, I mark based on consistency. So you have to be consistent with your value. So this one should be 37602. Then you update your balance. Update your balance. Okay, since you have issued 9, so you have available 18, isn't it? So 18 minus 9, so 9 unit. Now be careful with the value balance. So the total is 752. Okay, 752. So you need to minus the value also. Okay, the value issued. So 752 here, you minus with 376.02. Okay, 752 minus 376.02. So by right, you should have here, not 376, but it should be 375.98. So can you write down in your answer 375.98? I don't want to write it here because otherwise it will be messy. So I want you to write on your own 375.92. So we have to be consistent. Okay. Now, okay, why I use the previous balance total minus with the issued total? Okay, because we want to ensure the accurateness of the total cost. Because if you use this quantity and then times with cost per unit, the total amount will be far different from the actual. So we do not want to reflect that. Okay, we must get the actual total cost. So that's why the total previous balance value 752, you need to minus with the issued value. Then you get 375.98. So meaning the total cost will be the same, isn't it? And you update your average cost, okay, which is 375.98. Okay, you divide by 9. So you get same thing lah, 41.775555. So meaning it's still 41.78. But I mean, this is coincident, it's the same. But in different figure, it will show different effect. So I want it to be consistent, all right? So make sure you follow what I said just now. Then the next following transaction on the 15th, okay, we have purchases. We have purchases. Huh? So if we have purchases, so you record under receipt column. So record quantity 6 purchases with the price 48 times so 288 and update your balance by adding 9 plus 6 become 15. 376 plus 288 become, sorry, this one should be just now 376.98, isn't it? Plus 288, so you should have 663.98. Is it correct, Calvin? Are you lost or you okay?
Okay. You're just adding and then dividing only this. Right?
Yeah. Okay, so divide with 15, then you should be getting just now, let me calculate, 376.98, is that? Plus 288. So you should be having 664.98. Am I correct or not? Oh, sorry, that is 375. 375.98 plus 288, 663.98. Then divide by 15. So you should be getting 44.265. So 265, meaning we have to do approximation 2 decimal place. So it become 44.27. Same like this lah. Okay, so that is coincident only. Then the next on the 18th, we have sales 11th. So 11th. So use that average that we have calculated here. So 11 times 44.27. Okay, 11 times 44.27. So you will have 486.97. So it should be consistent. So you write down 486.97. Now, update your quantity, 15 minus 11, so 4 left over. And the value column, so when you update the value column, 664, you minus with 486.97. So you should have sorry, you have initially you have 663.97 minus 486.97, so you should have 177. So this is coincident only, it's coincident the same. Okay, so you have the same amount 177, and then with 4 unit, so average it out. 177 divided by 4 unit, so you get 44.25. So this one is a little bit wrong. Run about 2 point, 0.02 point. Okay, so the accurate answer should be 44.25. Okay, so then the last transaction is we have purchases. 4 unit with a price of 52, total of 208. So update 4 plus 4 become 8. And then 177 plus, 177, oh yeah, 177 plus 208. Okay, so 385. So 385 divide by 4. Sorry, divide by 8. Then you get 48.13. So luckily 48.13 is the same, the last information, isn't it? Okay, but then the main point is we have accurate value of closing inventory 385. Okay, for weighted average, okay, we take the last row 385, and then the cost of sales will be 863. For inventory, you take the last column, the last row, but for cost of sales, you plus all the value column. Why? Like what I've said just now, for the balance column, you keep updating. I mean, the process of updating has been done. So take the last row. But for issue column and receive column, we did not do the updating like we have done in the balance. So that's why, so we can plus the value column in order to get the total purchases and the total cost of sales. Now, is it okay?
Why is the pull down need to right?
Come again?
Why is the pull down? Why right there?
Oh, pull down here. Meaning this 41.87 pull down. I don't know, but it shouldn't be here. So you don't have to write all this. Total RM per unit, no need to write. This is actually only guiding you how to do. Pull down meaning you have to minus probably 18 minus 9, okay? And then 752 pull down to minus 376 become 376 now. Pull down. Okay, but then you don't have to write, no? Don't need to write this.
Oh, okay.
So the pull down can actually it's not correct can supposed to be the other one 375.98 divided by 9, right?
Yes. This one is coming from here 75. Forgot already. This one should be 375.98. Yeah.
Yeah. Then divide by 9.
Yeah. Divide by 9. Correct? Okay, Nat, do you have any question? Correct. What happened to your camera?
It's go to it.
Nolan. Okay, we have 5 minutes break. Yeah.
Okay.
Can we start? Sorry?
Maybe he's in toilet. His stomachache.
Oh, contradiction. I told you before.
In the Google chat.
Oh. Okay, Noel, you have to, I think he missed part of it. Oh, but then I did record it. Okay, so now the theory part. So cost of sales, if you look at the cost of sales for first in, first out is 848. And then weighted average is 863. Okay. And so what do you think? Cost of sales, if it's first in, first out, is lower. Okay, why? Because they are charging the cost of sales based on the old price, which the price is lower. Because if you look at the question, the price is increasing, isn't it? Increasing, which is showing inflation time. Okay, so that is why if cost of sales is lower, your closing inventory will be higher. Why? Because closing inventory is using the latest price, which is higher prices. So what happened to the profit? The profit is higher, isn't it? But weighted average, because we are doing averaging, so the cost of sales is not, the cost of sales will be a little bit higher from first in, first out. So thus, the closing inventory will be much more lower than the first in, first out. And the gross profit, okay, will be lower in weighted average comparing with first in, first out. Okay, so first in, first out method will give the lower of cost of sales figure. So the higher closing inventory figure and the higher gross profit figure, like what I've explained to you just now. Yeah? And then weighted average method will give higher cost of sales figure, the lower closing inventory figure, and the lower gross profit figure. Why? Because of the averaging process, that is smoothing the cost per unit. So the above illustration reflect an inflation period, okay, when prices are increasing over time. So under the first in, first out inventory valuation method, the first inventory purchase is first to be sold. So sometimes you are asked to explain first in, first out. So they have this assumption, the first inventory purchase is the first one to be sold. So during inflation, the higher price inventory will appear in the statement of financial position because we are talking about the closing inventory using the most recent purchases price. So meaning you will have higher inventory in the statement of financial position. And the lower price inventory, earlier purchases will be included in the cost of sales. So therefore, cost of sales will be lower, and closing inventory reflect the latest market price, which is higher. Whereas on the weighted average, the goods sold are based on the weighted average of all purchases. During inflation, the most recent purchases, higher price inventory, are also included in the weighted average cost, therefore resulting in higher cost of sales figure. So the earlier purchases, lower price inventory are still included in the weighted average closing inventory, resulting in lower closing inventory in the statement of financial position. So meaning in weighted average, they consider all the prices, either the higher prices or the lower prices, because we add the existing with the new purchases. Then we divide with the quantity, isn't it? So that explained, we have few advantages and disadvantages of different method. Now, if we are using first in, first out, okay, the advantages is more realistic. Okay, realistic in terms of, okay, normally, uh, this is the normal practice of a human, where the first that came in is the first one that to come out, because we afraid of expiry, like the veggie. You buy the veggie, you have to consume the first veggie that you buy first. Otherwise, if you consume the earliest one, so the old veggie become outdated, isn't it? Okay, so it is realistic because it's based on the assumption that inventory are issued in the order in which the goods are received. And inventory value are easy to calculate and based on actual price paid. Easy to calculate in terms of we refer with the invoice. So you don't have to decide, you don't have to recalculate, isn't it? Just like an average cost. We have to do the averaging. So we just refer from the invoice, and all these are based on actual price. So that is advantage. Closing inventory is based on the most recent purchase price that reflect the current market value. So that is an advantage also, because the value of the inventory, we are using the latest price. So meaning uh, we base on the current market price. And this another advantages is acceptable by Inland Revenue Board. And not only Inland Revenue Board in Malaysia, so this one also acceptable international financial reporting standard. Okay, so those are the 5 advantages. Now we have 3 disadvantages in, first out, because in a manufacturing business, raw material used in the production are taken using the earliest price, outdated price, which is unrealistic when setting the selling price of the finished good. You see, when we charge into the cost of sales, we are not using the latest price. Instead, we're using the cheapest price, isn't it? The price that is being outdated. If the current one is high price, so we should set our selling price higher. But since we are using first in, first out, we don't uh, we don't take that into account. So this is unrealistic. And the disadvantage is, second one is identical item of raw material may be issued to production at the different prices simply because they are deemed to be made out different batches of purchases. So meaning we are using the same item, but it's just that they are from different batches, so different price. So we are charging differently, but they are not different item. So identical item. That is the disadvantage. Okay, we are issuing at a different price because they are made out different batches. And during inflation period, first in, first out value, close inventory at the latest price, which is tend to understate cost of sales and hence overstate profit. So this is not conformity with the prudence concept. So even though this is unacceptable by Inland Revenue Board or International Financial Reporting Standard, but is actually against the prudence concept because we are overstating the value of the closing inventory. Okay, so that causes your profit to be overstated. Now, what about weighted average? Now, weighted average, the advantage is we have five. One of them is as prices paid for identical item purchased at different time are average. So meaning weighted average recognizes all such items have an equal value. Unlike uh, first in, first out, we have different value, isn't it? But it's the same thing, same item. But in weighted average, they are considered equal value. Because why? How do we consider as equal value? When we do the averaging, that is giving the identical item the same value. Okay, and that minimize the variation in the value of raw material issued to different production, even though they are issued from different batches of purchases. Okay, we minimize the variation. So meaning when when we consider the purchase price, sorry, the selling price. So our selling price is not, I mean, we can still detect what is the profit because we already minimize the variation. And averaging has the effect of smoothing out cost of production and cost of sales so that profit of different period may be more realistically compared. Okay, so meaning one of the advantage of weighted average because of the process of averaging, so we are actually smooth the prices even though the prices are different from different batches. So when we do comparison, okay, the profit especially, so the profit can be comparable because you already average it out. So you already consider every aspect of the price. So meaning they'll give you a more meaningful comparison. So that is uh, averaging has the effect of smoothing out, okay, which is resulting more realistically comparison. And the fourth one, the valuation of the closing inventory will usually be fairly close to latest price paid. Okay, even though the price is not as accurate 100%, but it is more or less the same. It's not too far from the actual price because we do averaging, isn't it? But then, if we are using first in, first out, the price very far different. Yeah. So the look at the closing inventory and look at the price that is charged in the cost of sales. It's far different because we are using the actual price. But for average, okay, we do the averaging. So the price, the average price is not so far from the actual price. And the last one is weighted average cost is suitable in computerized accounting system, computerized inventory control system, compatible. Okay. But for first in, first out, it's not suitable for those company using computerized inventory control system. Now, this advantage is a new average must be calculated for every purchase of inventory, like what we have done just now. We plus the existing one plus with the new purchase, and then we do the averaging. So it's very troublesome. It doesn't, I mean, we have to do the averaging every time we have a new purchase. And the calculated average price does not represent the actual payment to the supplier. Okay, so these are the two disadvantages on weighted average. So how do you decide which one to use? It depends on the company. They have to look at the policy. Okay, the business will have to choose between first in, first out on the basis which one is the closest to the nature. So if it's they are dealing with expiry item, so probably they need to use first in, first out. Okay, and then the overriding consideration is the need to give a true and fair view of the profitability of the business enterprise over the reporting period and the financial position of asset, liability, and equity at the reporting date. However, what constitutes true and fair view is not precisely defined, and it rests with the judgment of the decision maker. Okay, so meaning if it's true and fair view, of course, the closest one will be average cost because the price is not far different from the actual price. But then, which one is true and fair view? It depends on individual. So that is very subjective. Okay, judgment based on the judgment of decision maker. And the choice of method may also be determined by other factors, such as ease of recording, calculation, compatibility with the computerized inventory control system, commonly used method by other business in the same trade industry. So these are other factors that you need to consider, three factors. So the first one, which one is more easy to record? So people find weighted average is more easy to record. Okay. And then which one is more compatible with your existing system? So if your existing system is computerized, so it's better to use average cost. Okay. And then look at the other competitor in the same industry. Are they using first in, first out, or are they using weighted average? Normally, you follow that trend. If they are using weighted average, then use weighted average. Okay, so that's how we decide. And the next thing is quantity of inventory. So that is the second issue. How do we decide the quantity of inventory? This part, just now, what we have done is based on the value per unit. So we have first in, first out, or weighted average. Now for quantity, we have two methods. One is perpetual and the other one is periodic. So perpetual is what we have recorded just now. That is, every time we have purchase and every time we have sales, we immediately update the balance. That is perpetual. Okay. So periodic, meaning at the end of a certain period, then you do the physical stock taking. So periodic stock take meaning you are checking one by one of the item. You count one by one the closing inventory. So purchases come from record, so can calculate cost of sales. So periodic, we have to do the stock taking. But perpetual, like what we have done just now, that is continuously processed. We're updating the stock record. So closing inventory, purchases value, cost of sales, you can determine at any point of time. Okay, because you just refer from the bin card and see how much is the leftover. Okay, perpetual, periodic is not. You only have like if you do twice a year, so meaning at the end of June, then you do stock taking. At the end of December, then you do the stock taking. So you can only know how much is the leftover of the inventory at that particular time. So how do we manage to get an accurate quantity of inventory? So business trading is a continuous activity, but financial statement must be prepared at a particular date. So some of the company, they do half yearly. Some of the company, they do monthly. So it depends on the policy. Yeah. So the closing inventory quantity must be determined as at a particular date in order to calculate an accurate amount of inventory to be included in the financial statement. Okay. So meaning, how do we manage to get accurate quantity? We must do a physical stock taking. Okay. So the two approaches determining an accurate quantity of closing inventory, we have perpetual method, like what we have done just now, recording the inflow and outflow of the inventory throughout the period, meaning throughout the period, we keep updating the balance. So separate record, meaning separate inventory card. The inventory card we are referring with the bin card, are open for each and every type of inventory. So if you have A, B, C, D, so you have bin card A, bin card B, or stock ledger card A, stock ledger card B. Okay, by comparing the inflow and outflow, it is possible to calculate the balance of inventory on hand at any point of time. So we have the illustration one just now to reflect the perpetual method. So because of the presence of this perpetual continuous record, the quantity of different item inventory can be obtained. So if the movement of the inventory are recorded properly, the perpetual method can provide very accurate balance of the inventory. Okay. But even though perpetual method is very accurate, okay, the business need to conduct physical inventory count, meaning physical stock taking. Yeah, at the end of financial year, for instance. Normally they do it only at the end of the year in order to compare and confirm the accuracy of the inventory record in the stock ledger. Theoretically, both balances should agree. So nevertheless, there is normally a difference between the counted physical balance and the record balance due to theft, spoilage, misplacement, etc. So any difference should be investigated properly, which figure to follow. Okay, meaning even though the perpetual method is very accurate, so we still have to do the physical stock taking. Okay, and then the reality is when we do the stock taking, we always have the difference between the perpetual record with the stock taking. Okay, why? The reason being, okay, because of theft, meaning your staff probably stole it. Okay, spoilage, meaning part of the item become spoiled, yeah, destroyed because of the heat, because of the rain, yeah. So that is being spoiled. Or misplacement, you misplace, you don't know where did you put it. Okay, so under perpetual method of accounting, the cost of goods sold is taken directly from the inventory account in order to prepare, okay, the statement profit or loss. Therefore, the format of statement profit or loss is slightly different from that using periodic method of accounting. Okay, meaning if we use a perpetual method, so like what we have here, we can get the cost of goods sold, okay, from using this inventory card. Okay, because all of this information we have, isn't it? So like remember inventory, as what I've explained to you, is an asset. So meaning any purchases increasing the inventory amount. So we do recording on the debit side. When we issue, since we have the information on the closing inventory, we record here 400, isn't it? So debit balance. So 400, 400. So the balancing figure is actually the cost of goods sold. So we just record it in the inventory account. So all of this information we have, like what we have just now, isn't it? So opening balance, we have 400. Okay, we have three occasion of credits purchases. So 352, 288 record on the debit side. And we have two occasion of sales, 360, 488. If you look back on the illustration, you can get all this figure. Okay, so I will explain again. Okay, next week. So we continue next week. Yeah. So you have your tutorial class. That's all for now. All right. Okay, class.
Okay. Okay, sir.
Okay.
Yeah. So I'll see you next week. Yeah. Oh, sorry. Tomorrow we have test. Huh? Don't forget.
Okay.
7:30.
Thank you.
7:30. Yeah.
No.
Okay. Bye.
Oh, okay.
Hello. Noel, how is your preparation for test? How's your test preparation? Why today 6 p.m.? Any things to do? Oh. Actually, you are ST year 1 or year 2? Year 2. I see. Year 2. Year 2, so now is when you join is what? When you join what? May intake or October intake? May intake only, right? There's no. Yeah, for RSD there's only May lah. There's no October. I think your test one should be okay lah. The test you are very basic. So like I said lah, the first 3 chapter, if you can understand the tutorial question, you can do, then it should be okay lah. No problem. Yeah. So go and look back at your tutorial question. I don't think it will be harder than the past year lah. Yeah. The past year, the 3 questions that I passed to you, is it related to your first test? Is it? Yeah, I cannot remember. Okay, so we continue. Okay. Today we quickly do this one, and then later on, if we have time, then we do what the test one. See, and if you have any question to ask. So anyway, like Noel said, he's going to do revision tonight, right? So if you have problem, it's okay. You just text me. Yeah. But normally after 11, I sleep with you. Yeah, so you can text me. Okay, because I believe if you haven't done your revision, right, you got no question to ask, right? Okay. How about Farah? Farah, okay, right?
Yeah.
Are you doing well? I'm still waiting for your answer. Noel, your tutorial 6, right? Okay. I need to install the pen tablet because my desktop got a bit upgrade, so I forgot to install. Yeah. So just now I wanted to use that. I said, cannot use. Yeah, forgot to install. Okay, let's see our question. Today is tutorial 7, huh? Correct, huh? Right? Because the day we do depreciation, right? So today is tutorial 7. Tutorial 7, you can see my screen, right? Tutorial 7 is about trade receivable. Yeah, your lecture note is 9 pages, but I believe your lecture note example, all these things is also very, very complete. So if you look at this one, right, your section A, your section B, section B question 1 is a very good question to test your understanding. Yeah, if you have time, then we do, or else, okay, you can try, then, yeah, then I mark, and then the following week, then we see how, okay? Right, so we start from this one, the first question. Okay, now the first question is actually test your understanding of whether you understand what the question say or not. If you understand, the answer is actually very straightforward now. So it says here, Adam's trade receivable as at 31st December is 28,000, right? Then a bad debt of 1,002 has been written off from the trade receivable. Okay, yeah. So I said, this one, you see, has been written off. So meaning this 28,000 already deduct 1,002 or not? Already deducted? Already deducted? Anyone?
What's
What do
the
you think?
question again?
What, the question I projected, can you see? You said Adam has this trade receivable at 28,000, and then a bad debt of 1,002 has been written off from the trade receivable. So my question is, this 28,000, have you deducted 1,002?
Oh, already.
Already.
Yes. Yeah, already correct. Yeah, actually already deducted. So he is of the opinion that about 3% of this outstanding balance. So this outstanding balance refer to this one now, 28,000. Will not be able to be collected, and she wants to make an appropriate allowance to reflect the uncertainty. Okay, so now you want to actually include the 3% allowance for doubtful debts. So how much would be shown as the allowance for doubtful debts? Yeah. So the question asks, how much is the allowance for doubtful debts? The allowance for doubtful debts, I always like to say AFDD. You know the short form AFDD, right? Allowance for doubtful debts. So what is the answer? How do you know how to calculate allowance for doubtful debts? And do you know what is allowance for doubtful debts? Okay, in this chapter, what you need to know is what is trade receivable. When we say trade receivable outstanding, meaning we are waiting for the customer to pay us, right? Okay, trade receivable is the customer hasn't paid us. Okay, bad debts is bad, meaning no hope really, no hope. Can't collect from the customer. So we write off as an expense. No hope really, right? So just write off lah. Yeah, okay. Allowance for doubtful debt is we estimate. We estimate, like for example, question 1, we estimate out of 28,000, we say that there are 3% maybe, okay, maybe cannot be collected. Yeah, okay, maybe, allowance for doubtful debt is maybe cannot be collected. Now, according to prudence concept, if we are able to estimate, then this one must be treated as an expense, correct? No? Yes, treated as an expense for our current year, right? Yeah. So I hope you are able to differentiate between bad debts, allowance for doubtful debts. Okay. So in the statement of financial position at the same date. Okay. So what is your answer? Anyone?
840.
840. How do you get 840? How do you get 840?
28,000 multiply
28.
3%.
Yes, very good. Yeah. Okay, so because bad debts already deducted, so I think during lecture you also know now, before you calculate allowance for doubtful debts, you must make sure bad debts already deducted, right? Because bad debts means no hope already. So if no hope, then deduct from trade receivable, right? Then the remaining, you time a percentage, then it become an allowance for doubtful debt. Meaning we expect, like for example, this question, we expect 240 ringgit maybe cannot be collected, right? Maybe cannot be collected. Is that correct? Yeah, we expect, okay. We actually predict so maybe this amount cannot be collected, correct? Yeah, so your answer is correct, 840. All right. Okay, then number 2. Okay, so yeah, you see, this one is actually to test your understanding of reading and whether you understand what the question says. So this one is Colin, 180,600 outstanding from trade receivable. So meaning we are waiting for the customer to pay us this amount. Yeah, okay, outstanding trade receivable. So there's a bad debts of 1,004 to be written off in addition to an amount of 900, which has been written off earlier. So what does it mean in this sentence? You understand what does it mean or not?
They already pay the 900 for the bad debt.
Pay who is paying?
The Colin.
No.
Oh no.
No. You see, it said there's a bad debt of 1,004 to be written off in addition to an amount of 900, which has been written off earlier. Meaning 900, this 900 is already a bad debt, which we already deducted from this amount. Is that correct? Which already been deducted from this amount. Now the question says we have another 1,004 to be written off. Okay, so my first question is, how much is your total bad debts? How much is your total bad debts?
2,300.
Your bad debts in total? 2,300. Yes, yeah. In total, our bad debt is 2,300, right? Okay. Then it says, so meaning earlier on 900 already deducted from trade receivable. Now we have additional 1,004. So it meaning in total bad debt is 2,003, correct? Okay. Then she has never made any allowance for doubtful debts prior to this, but her experience indicate that 2% will become irrecoverable. So what is the amount of AFTD? Okay. So what is the amount of AFTD? So what is your answer? How much? Everybody type the answer at the
3612.
3612. No, not 3612. Not 3612. How do you calculate? So basically, you start with your trade receivable, correct? You start with your trade receivable, right? Okay. Then you minus, what do you minus?
Oh, I forgot to deduct.
Uh,
1,400.
Yeah. Yes, yeah. You have to deduct 1,004. How about the 900?
How
How about the 900? 900 already deducted, right? Because you say already written off, right? Okay. So times 2%, right? So how much is your answer? Okay, correct, So you have to minus the additional 1,004. So your answer is
3584.
yes, 358. So this is your answer. Okay, so this is your answer. Yeah. Can I? Can understand, right? So don't get caught by the question. So when you read question, please be careful. Okay, how about number 3? Okay, 3. Venture trading provided the following information as at 31st December. So you have trade receivable this much, allowance for doubtful debt. I see BD. BD means this is a what? This is actually an opening balance, right? Yes, this is the opening balance. Okay, this is the opening balance. Right. So I said there are further debts amounting to 840 to be written off. You see the word to be written off, meaning already deducted? Already deducted from trade receivable? Already or not?
Hmm.
Already deducted or not yet? Already or not yet?
Or already.
Not yet. I said to be deducted now. Right. To be written off. So not yet lah. Okay, not yet. Yeah. So allowance for doubtful debt for the year 31st December is 3548. So the question actually tells you at the end is 3548. You see that here also got one allowance for doubtful debt 2006, and this one is another one. But this one it says 31st December. You see this one also 31st December. So somehow you feel confused, right? Okay, actually BD, this is the opening. This is the closing. Right? So this is opening, this is the closing. Yeah, this is opening and this is closing. So what are the amount of doubtful debt in the SOPL and allowance for doubtful debt in the statement of financial position at year end? So how do you, okay, this one actually, we want to know how much is the doubtful debts that you actually write off in the SOPL? And how much is the allowance for doubtful debt that you are going to put into your SOFP? That is actually the question. Right, so this one, okay, I show you from here, right? Now, so for this, so okay, I'll show you the T account, the 1, 2, 3, 5, 6. Show you the T account, it's actually better. Okay, so this is AFDB, and another account is called doubtful debts, right? You learn this one, isn't it? Correct? Okay, another account which is called doubtful debts, BD lah. Okay, yeah. Now, so from the question, we know that we have the opening balance now. For this allowance for the AFDD, where is your opening? Debit side or credit side? This allowance for doubtful debts account, always the opening is debit side or credit side?
The
Debit side or credit side?
credit.
Yes, credit side. Okay, it's the credit side. So you put here balance BD, isn't it? Right? Okay, yeah. FDD is on the credit. Now you see, trade receivable is on the debit. FDD will be on the credit. Or else, how do you find net trade receivable? Right? Okay, so according to the question, this oh, yeah, somehow it's very a bit difficult to adjust sometimes. I am not good in doing this thing. All right. Okay. Yeah. Now, so you see, according to the question, right? Okay. Yeah. The question say like this lah. So our opening is 2,600, correct? Yes. Okay. And then the question say, now, and then the question say this one is that allowance for doubtful debts, right? 31st December is 3,548. 3,548. So what does it mean? Okay. This question, if you seriously, if you look at this question, is there any information given, like how many percent? Any information given so that you're able to find AFDD? Normally, the question give you 2%, 3%, right? But you see, this question, there's no information on how many percent is the AFDD, right? But the question tell us at the end of the year, the AFDD is 3548. So meaning this is the what?
The AFDD.
The AFDD for the year end, correct? Yes, AFDD for the year end. So meaning, okay, so meaning this is the balance CD lah. Isn't it? Correct? This is the balance CD lah. Meaning at the end of the year, my AFDD is 3548, right? Okay, now, then you know that we have to close this account, right? At the end of the year, we have to close this account. Now, in order to balance debit side and credit side, in order to balance, so you will put an amount here, right? Because here is 3548, here is 26. So if you want to close your account, okay, yeah, you want to close your account, it will be like this, right? Right now. So meaning in this case, right, this AFDD, is it an increase or decrease? Is it an increase or decrease? Yeah, it's an increase, right? So here you put DD, right? Alpha steps. So increase by, okay, so we take this one minus this one. Okay, so it's actually decreased by 948. So actually this is the answer that we want. Right, okay, this is the answer that we want. Okay, then, so double entry, we're going to do double entry. So here is credit, then we transfer to here become debit, 948 is here, right? Okay. And here, we actually put AFDD. Right, okay, and then how do you close this account? An increase, income or expenses? An increase in AFDD. Income or expenses? When you have an increase in the FDD. Yes. Why is it an expenses? How do you explain?
It costs you money.
Okay, yeah. When you say expenses is actually correct, but why is it is an expenses when it's increased? Okay, it's very simple.
Because
now, what is it? What is AFDD? Yeah, yes.
Because decrease the trade receivable.
Yes, meaning the money that we're going to receive our customer is lesser. Lesser means it's our expenses already, right? Because AFDD is actually to calculate the amount that we might not receive. So imagine the higher your AFDD, the more money that we can receive. So is it good? No. If you can't receive, then it becomes bad debt. So bad debt is an expense. So that's why an increase in allowance for doubtful debt is an expense. Okay? Yeah, so you understand, right? Okay. So meaning this one at the end, we are going to actually transfer to our SOPL 948. Okay, so this account closed already, lah. Okay. This account closed. Yeah, okay. Balance. Okay. So your answer. So okay. So yeah, so you can actually use this one to actually show your answer like this. So this is an increase. So if an increase, it is an expense. Yeah, if an increase, actually as an expense. Right? So meaning in SOPL, we are going to recognize 948 as an increase in FDD as an expense. Okay. Now, what happened in SOFP? In SOFP, how are you going to do it? So in SOFP, correct? So under your current asset, you have trade receivable, right? Then you have less AFDD, right? This one you can see from the lecture notes, okay? So you can see like this one. So how much is your trade receivable? How much is your trade receivable? Berapa trade receivable? You understand what the question said? 71. Let's put it this way.
7100.
7100. Eh? Do you need to minus the 8,840?
Oh, need not.
Who be written off kan? So meaning 71, 800 and to minus 840, correct? Okay. Now, then how much is your AFDD? AFDD already, question already give us, no? So it's this number, right? Right? So this one will give you what? 71 minus 840, so it is 70960, right? Okay. So this number, it become, yes, this, right? So this is actually what you want. Okay, 67,500 there. So this is what we call net trade receivable. So meaning we assume that, well, because of the allowance for doubtful debt, so we only able to collect in full is 67,412. So this 3,548 might not be able to collect back. Okay, yeah. So in your SRFP, this is the amount that you put for your AFD. Yeah. So answer the question already, right? Can you understand so far? Any question?
So both bad debt and doubtful debts is under the expenses.
Yes. Okay. So I'll
Oh.
show you. In SOPL. Okay. In SOPL, under expenses. Okay. Under expenses, right? Okay. You have okay, in SOPL under expenses, right? So you will have under expenses. You will have backups. Yeah. Okay. You have backups, and you have doubtful debts. Now, these doubtful debts, right? Normally, we can also put, either you put doubtful debts, or, okay, normally we will put increase in AFDD. Normally, we'll put like this, okay? So, bad debts, okay, like this. Increase in doubtful debt, like this. Betul?
So if
Yeah.
decrease means revenue.
Yes,
Oh,
you are
okay.
right. Yeah. Yeah. So this one you have to remember. If decrease, is it a good thing? We are going to receive more. It's a good thing, right? So it's become income. Okay, yeah. Right. So any other question? If no, then we go to question 4. Okay, now for question 4. So okay, for question 4, the trial balance of safe and sound as at 1st June, review the following. Okay, I think we look at what we need to do first. Trade receivable control account, bad debts account, allowance for doubtful debts account, SOPL, SOFP. Extract means you just show the part that you are able to fill up, right? Okay, so wow, a lot of 6 different things. So trade receivable, this is shown at the trial balance. Trade receivable, you have this much, bad debts, you have this much, allowance for doubtful debt, this much. See, this is opening. You see, BD means opening, meaning in this year, this is the opening. So normally the question wants you to find closing. So before the accounts were closed, the owner decided, okay, number 1, to write off an amount of 4,005 owing by Boris because the amount could not be recovered from him. Could not be recovered. No hope lah. This Boris cannot pay. Okay, so treat as bad debts. Okay, number 2, it was decided to reduce the allowance for doubtful debts for the year to 22195. Reduced to, now you see, how much is your opening? 23220. How much is your closing? Is it decided to reduce for the year? So meaning this is your closing. Okay, this is actually your closing. This is actually your closing. So tell me, is this an increase or decrease in doubtful debts?
Decrease.
Yes, it's a decrease. Okay, it's a decrease. Yeah. So you understand what the question asked, yeah? All right. Okay, come. We have to do some question. Okay. Right. 1, 2, 3, 4. Okay, I need 4. So I better. Okay. Make the template. 1, 2, 3, and 4. Okay. Yeah. Right. So the first account we need to do is trade receivable control account, right? Okay, according to the question. Now, so trade receivable control account, how much is our opening balance? Yeah, how much is our opening balance? Question 4. A little bit smaller. Okay, how much is our question? Our opening balance.
502,740.
50, yeah, okay. So this opening, okay, now we want to put the opening, right? So this is actually all our opening now. Debit side or credit side? Debit or credit in this account.
Debit.
In trade receivable control, debit or credit? Huh? Debit or credit? Debit. Yes. Yeah. So it's actually debit. So you put that here. Okay, opening, which is 50,274. Okay, so debit. All right. Yeah. Okay. 50. Okay, it's here. Now, then any other thing that you need to adjust in your trade receivable control account? Any other thing you need to adjust? Any other thing you need to adjust or not?
I think no.
Are you sure? Okay, this bad debts already deducted? This bad debts already deducted?
The one I'm not sure.
This one already deducted. Yeah. If haven't deducted, you will not have this item called bad debts already deducted. So meaning you debit bad debts, you credit trade receivable already, because this is your trial balance already deducted. Any more bad debts? Any more bad debts?
The Boris.
Yes, we have more bad debts, right? Okay, so bad debts it will reduce our our collection, right? So then meaning we will have a closing balance already, no? Correct? Yeah, okay. So our closing balance, so how much is your closing balance? So, okay, this one minus this one, right? Okay, so this is our closing balance. Alright, yes, so our closing trade receivable. Yeah, our closing trade receivable. Right, 160,740. So this one is sum it up, okay, right? So trade receivable control account, okay, done. Now next is bad debts. Okay, bad debts. Okay, so bad debts. Oh, because this one we do month by month now. So let's say this is June. So now meaning we are in July. So meaning there will be a opening balance, right? Okay. So it's better it's an expense, so it's on the debit now. Yeah. Okay. The debit. Okay. So our expense according from our trial balance is 7120, correct? Yes. So during the year, any more backups? Any more backups during the year? Yes. Okay. So it's 4, 5, right? So what do you put here? What do you label this?
TR
Yes,
dash
TR.
Boris.
Yes. So you put okay. Dash Boris. Yes. All right. Okay. Then this account at the end of the month, you need to close it, right? So close to where? Expenses, am I right? Close to SOP, isn't it? Right? Expenses. Yeah. Okay. So
11,620.
and up. Oh, okay. So 1162. Okay. Yeah, 11,620. Yes. So 11620 and 11620, right? Okay. So that's account done. Okay, now we move to this side. Right. AFDD. Okay, we go for AFDD first. Now AFDD, how? This one is so you start from open debit or credit. You start from debit or credit.
Debit.
Are you sure? AFDD. Do you have a balance for AFDD? Yeah, here. So you have an opening balance, right?
Yeah.
So debit or credit?
Oh, credit.
Yes. Okay. So 23220. Okay. Now you look at number 2. What does it mean? Reduce to 22195. So just now I already asked, right? So your answer is a decrease. So when you see this one, this is a closing, right? Closing meaning if your opening is here, your closing must be this side already. Right? So meaning this is your balance sheet. So the question give you the the allowance for doubtful debts at the end of the month. Okay, so in order to get this account balance, yeah, so how are you going to complete this?
They write off the
So meaning, so you have
Debit.
you have a doubtful debts, right? You have a doubtful debts here, isn't it? Correct? Then how much is this? Right, the difference, right? Okay, so if you get this account balance, so what you want to find is this one. So this is a decrease. So if it's a decrease, meaning if it's a decrease, meaning it is actually an income. Okay, it's actually an income. Yeah, it's actually an income. Oh, okay, never mind. So now we do the last T account is this lah, double debts. So you can see double entry, oh. So here you put AFD, right? Okay, so it's 1025, and then here is SOPM, isn't it? Right? 1025. Okay. So in this case, this is an income because it's a decrease. Decrease is a good thing, meaning we are able to collect more. It's a good thing. So that's why it's an income. Yeah, okay, so it's an income. Yeah, all right. So now you see all the left 2 E and F. Okay, so if I show you everything, the whole thing like this, right? Okay. Yeah, you can see your double entry, right? Now see the double entry from your bad debts. Okay, bad debts double entry is here, right? And the other double entry, okay, here. Okay, this one also can. Yeah, right? Isn't it correct? Yeah, so that you can see the double entry, right? Okay, now the last 2 sections we have to do S or okay, here, this one. Just copy this one. Okay, SOPL, right? Okay, now SOPL, we know that we have income, right? It's like, okay. So SOPL extract now. So if extract, then we just do the part that we have the number. Yeah, so it is underline. Oops. So, okay. So you put here income, right? Income. Okay, then we put what? Decrease in FDD. Okay, how much is that? 1025. Correct? Yes. Okay, expenses. Do you have any expenses? Yes, we have bad debts now. So bad debts plus the 4,005. So in total, we have this number, correct? So you can see from, yeah, so this number is actually here, right? Yeah. And then the decrease, yeah, the decrease is actually here. Oops. Oh. The decrease is actually here, right? Decrease is an income. That's okay. So this one don't have all. You can only have either one, either decrease or increase. So that's why this one no number. Yeah. But actually no number, this one just ignore, just delete. Okay, so this is your answer for SOPL. Yeah, for SOPL, this is your answer. Any question? Okay, then we go for yes. No, so far so good. For SOFP, yeah, you want to ask anything? Yes, you want to ask anything? Sorry, I can't recognize your voice.
No.
To me, it's all the same. Okay, no, all right, now. So, current asset, okay, current asset, then we have trade receivable now. So, how much is the trade receivable that you're going to put here? What your trade receivable? What number? See from this account, how much is your trade receivable? Yes, how much is your trade receivable? From this account. Which one?
The closing balance.
Yes, the closing balance, yes. Yeah. The closing balance meaning 498240. Now remember, all the balance CD will always go to your SOFP. All your balance CD will go to your SOFP. Okay, you see, I highlight this one. I put in blue and this one. Okay. You see here there are two balance CD, right? Okay, now. So meaning this number you're going to put is 498240, right? 40, yeah. Okay. FDD, which is the closing, which is actually so done. So this is your answer. So isn't it both are balance CD and CD, correct? Correct or not? Yeah, both are balance CD, right? See, I already highlight. Yeah. So always remember your balance CD always goes to the SOFP. Your closing balance will go to the SOFP. Isn't it? Yes. So any question so far? No? So far so good? Okay, so we're done question 4. Oh. So do you want to take the challenge and do question 1 later or we do together now? Oh, okay. Do you have any question to ask about your test first? Or do you need any revision of the test?
What time?
Huh? Sorry?
Mean there's a Google Meet.
When is the Google Meet? You mean when you want to ask question?
Like 6 p.m. Do you have a Google Meet?
Oh, no.
Oh,
6 p.m. Why you say 6 p.m.? It's your time. It's your actually your time, right?
Oh, the test is so late. The test is
Your test is 6 p.m.
no, 7. It says 7 p.m. or 7:30 p.m. there. I think.
But your test is tomorrow, ma.
Yeah, tomorrow. Yeah.
oh yeah.
Isn't it? Yeah. So what I mean is, now our tutorial. Do you need me to go through your chapter 1 to 3?
Can you briefly go through? No, just
okay.
the SOPL and the SOPL thing and the
SOFP.
SOFP, that the
Actually, this
table.
one,
I think
yeah.
those are okay. Those are
Uh,
okay. Those are okay. I just
okay.
only the ledgers.
Actually, yeah, actually SOP and SOFP, this one actually you have to memorize. You have to actually memorize the format.
The format you already have in our Excel should be okay. Just when in the ledger
Yeah.
I keep I think I keep putting in the wrong places. Yeah, I might be.
I think okay lah. So far, I see your answer. Okay lah, not so bad lah. Okay, then we better go to your better do this one
Will
first,
there be
or
any
else
theory
later no
any
time.
theory questions?
Maybe, yeah, maybe there might be theory question. Yes, yeah, might be theory question. So for chapter one is basically the very basic one. So like what is accounting? Yeah, okay. So what is accounting? Bookkeeping is basically you just do recording, but accounting basically you do everything. So when come to accounting, basically you have to collect, you have to do record, you have to summarize, and you have to communicate. Communicate means you come up with SOP and SOFP. That is the end product. So accounting, this is accounting. 1, 2, 3, 4. This is what accounting does. Yeah. Bookkeeping, you only collect and record only. Okay. Bookkeeping is simpler. You collect and record only. That's it. You don't have to do summary. You don't have to come up with the financial statement. To communicate with other parties. Right. Okay. So this is a basic idea. Okay, then your accounting cycle. This is accounting cycle. So we start from source document. Yeah, source document like your receipt, your invoice, right? All this is your source document. Okay, then you have 7 books of prime entry. Yeah, and then you have 3 ledgers. Correct? 3 ledgers is what? Sales ledger, purchases ledger, and general ledger. Correct? Yeah. And then 7 books of prime entry. What are your 7 books of prime entry? Do you still remember? What are your 7 books of prime entry? Can you remember or not?
Hi.
I forgot.
Yeah, actually never mind. So then you have trial balance, right? And you need to do adjustment. I think you haven't up to adjustment yet, lah. Okay, yeah. Then you have closing. Now, your 7 books of all this accounting cycle. It can be 1 year. It can be 1 month. So it depends on depends on the question asked you to do 1 month or 1 year, lah, right? So the accounting equation, and this is very important one. See, all the asset is on the debit side, all the liability on the credit side, and equity also on the credit side. So meaning when you want to increase your asset, it must be on the debit side. For liability and equity, if you want to increase, it will be on the credit side. Yeah, right. So drawing is actually on the debit. Drawing is actually on the debit. Expenses on the debit. All the income on the credit. Right? Okay. And then so this is your accounting question. Yeah. Now, I believe during test, right, they will actually test your understanding of this one. Like I said, if we put asset 2,000, okay. So let's say the question said, the owner actually brought in 10,000 cash. Then they ask you, how do you make it balance? How do you fill in your number? So when the owner brought in 10,000 cash, right, as a capital. So basically you debit your asset net, and then you credit to your capital, right? So balance or not balance. Here is 10,000. Here also 10,000. Balance out. Yeah. So if you take note on your lecture note, okay, you will see. Yeah, ini macam kita sejuk. But I am having class or now. Can do other place first. Somebody want to come and check. My aircon is not very cold. I don't know why. Yeah. Okay, never mind. Ask him to come back later. Now, So then you have asset, then asset, we have non-current asset and current asset, right? So what's the difference? This is non-current asset is more than 1 year. Anything that is anything that we own and we can use it for more than 1 year, okay, that is called non-current asset. Current asset is we own, okay, but it's actually less than 1 year. Yeah. So the example here, yeah. Okay, liability also the same now. One is non-current liability, one is current liability. Yeah, also the same. So current liability is we actually owe. We owe to the third party. So non-current liability, this one is more than 1 year. Like you borrow a loan, the loan is like 5 years, 10 years, 15 years. This is under non-current liability. Current liability is actually within 1 year, like your trade payable. Like we are going to pay our supplier within 3 months, for example. This is within 1 year, so it's called current liability. Yeah, like bank overdraft. Okay, meaning you are going to settle within 1 year, right? Okay, now is it good to have a lot of liability? No, liability is actually a burden to a business. So we try to control our liability, like not too much. Imagine if you have a very high borrowing, any money that you borrow is not free. You need to pay interest, right? So this is the part that actually burden you. Yeah. So equity is basically the capital. So normally this one is from the owner. Now I'm talking about sole proprietor. Yeah, sole proprietor meaning there's only one owner. Okay, so he's the only one run the business. Yeah. Okay. And then this owner can do withdrawal, right? So what we call is drawings. Actually, why we say it's a drawing? Because it's for personal use. Yeah, it's actually for personal use, right? So equity will increase when the business make a profit. Yeah, when you have profit, your equity will increase. When you have loss, your equity will decrease, right? This one actually you can see in the SRFP. So revenue is actually income. Any money that you receive. Not necessarily money that you receive is an income, not necessarily. Like if you are buying and selling tire, every single tire that you sell to your customer, okay, that is our income. Yeah. If you rent out your shops, the rental income that you receive, okay, this is income. Yeah, right. Now, like for example, if the trade receivable make payment, is this our income? When they actually make the payment, we recognize the income during sales. So when the customer actually paid us, that one we don't say income. Yeah, it's the money that we receive. So that's why you debit cash or bank and you credit trade receivable account. Okay. Yeah. Other income is other than your main business activity. Like if you are in the business of buying and selling tire, okay, yeah. So your main income is every single tire that you sell. Now, other income here is refer to, okay, let's say you are buying and selling tire. So let's say your tire shop is there, it's huge now. So maybe you rent out 1/4 of your space. Yeah, and then you collect rental. Now, this rental that you collect is actually not your main business activity, right? Your main business activity is actually to buy and sell tire. So this rental income, right, is actually called other income. Okay, so you have to differentiate between the main business activity or not. Yeah, right. Okay, expenses. Cost of goods sold is considered as expenses because you need to buy, then you can sell. So what we make is a different. So we normally say what? Buy low, sell high. That's how you make profit, right? Buy low, sell high. Okay, profit. This is a profit determination equation. This is actually from this equation you are able to find your profit. So it's all your revenue minus your expenses. So revenue is on the credit side. Expenses is on the debit side. Okay, now profit. Profit, right, is debit or credit? Profit is debit or credit? Have you ever thought of this question?
Credit.
Yes, profit is credit. Yeah, profit is credit. So you realize that when you do your lecture, profit is always a credit. Okay, yeah. So this one you understand your income more than expenses is profit. If the other way around is a loss. Now, in accounting, everything must be balanced. That's why we say it's a dual effect, double entry. You have debit, you must have credit. You have debit, you must have credit. You have credit, you must have debit. This is the law. Must. Okay. So yeah, must your it's like your right hand side must equal to your left hand side. This is the must. So that's why your S or FP must be balanced. So we actually use this accounting equation. That's why it's actually balanced. Okay. So this one, if I'm not mistaken, I ever saw a question like this. This is a very basic to test you. So make sure you know how to fit in. You know whether your asset increase or your liability decrease, so you're going to decide. But at the end of the day, make sure it's actually debit. If your debit side equal your credit side, so this is debit. Yeah, here is debit, here is credit. Yeah, okay. All right. Identify whether debit, credit. This one, all these items. Okay. At the beginning, first lesson I already told you, right? You must be able to recognize what is the item. If you are able to understand what is telephone, then you know this is an expense, right? So that's why there are some of the terms you know, like motor vehicle. You know what is motor vehicle, then for sure you will tell me, oh, this is non-current asset. Yeah. Purchases is an expense, so it's a debit. Yeah, something like that. Okay. So debit, credit. So you see, so expenses on the debit. Actually, we can add in one more. That is drawings. Yeah, drawings also on the debit. Liability, income or revenue, equity. This is all on the credit. Okay, this is all on the credit. All right. Okay, recording system double entry. Debit, credit. This one you already know. Yeah. This one. Yeah. Okay. This one profit. So this one. Okay. T account. Actually, if you study your lecture note, you get a lot of info. See, asset liability, one debit, one credit. It's always double entry. See, not? Yeah. Okay. Always double entry, right? They always have two effect. So we can go through this illustration, okay, one by one. Then eventually you catch up, you know what's going on. Question like this is important, so make sure you okay. Now, I give you some tips. Any illustration example in your lecture note, please go and read. Your test might be similar to the illustration or example in your lecture notes. It might be similar. It might be similar. Okay, like this. Right? Okay. Who are the user of accounting knowledge? This one can be the theory that they test you. Who actually need financial information? Yeah, and why do they need? Like here they say the owner or the shareholder. Why do they need? Why do they need? Yeah, so why? They want to know the profit or loss, the financial position, the stability, right? Okay, the growth, correct? So the question asked, so the management, why management need accounting information? So they need it for planning, organizing, controlling, coordinating, analyzing, appraising. Employees, why do they need? Yeah, all right. Okay, external, this is internal. Internal meaning within the company. External is outsider, like bank, your supplier, all these are outside from your company. Why do they need accounting information? So all here. Okay, so they might ask you to give example lah. Who are the, who are the parties who are actually need accounting information internally? So internally, yeah, your answer is here. Externally, your answer is this one. Okay. Yeah, right. And type of organization. How many type of organization we have? So basically, we have trading, retail, wholesale, manufacturing, service industry. Yeah, so I believe this one okay lah. This one you should be able to understand. So normally for us, we actually buy from retail, right? We very unlikely that we can buy from wholesale because why? Wholesale sell in bulk. Yeah, wholesale sell in bulk. So normally, like a normal consumer, we normally buy from retailer. Yeah, okay. Like you go to supermarket, right? You don't buy from wholesaler. Wholesaler say, wow, you want to buy, I want to sell you in 100. Do you need so many? If you need so many, you can buy from wholesale, or else no. Right? Okay. Manufacturing. Yeah. Okay. Manufacturing is the manufacturer. So normally, manufacturers sell to wholesaler, and wholesalers sell to the retailers. Yeah. Okay, service industry, okay, like TAUC is providing service. So we are actually called service industry. Yeah, like insurance company, bank, hairdresser, consultancy. The main, how do you differentiate between service and non-service is service, basically they do not sell you goods, right? Meaning you don't buy goods. It's like tire is considered a goods, correct? You go to stationery shop, pen, eraser, foolscap paper, all these goods. But service that you don't buy goods, okay? Yeah. You don't buy goods. Okay. Yeah. So modes of business ownership. Yeah, modes of business ownership. So we have either sole proprietor is actually there's only one owner. Okay. Yeah. Sole proprietor is basically there's only one owner. Yeah. So a small business. All right. Okay, so at the moment, do the account that you do now is actually a sole proprietorship. Okay, somebody is talking very loud outside. Okay, hang on, I can close the window. Okay, so sole proprietorship, yeah. So this is actually a one-man show lah, yeah. Okay, it's only owned by individual, so it's a small business. And where to get the money? From his own saving or from the family, right? Okay, so basically, sole proprietorship is you make profit, very happy lah, you get all the profit. But if you make losses, you are the only one who suffer long. Nobody can actually help you. Yeah. Okay. Now partnership is basically partnership. Normally we say 2 to 20. Yeah, partnership. So partnership is we can actually share. You know, we can actually pool our resources lah. So if you have partner of 3, then everybody must contribute with some capital. So it's better than sole proprietor, right? Yeah. And then in terms of work also, let's say why we form partnership, because maybe let's say normally partnership is like those clinic you know, those clinic, law firm, accounting firm. Normally, yeah, they will have they will actually, you know, work as a partnership, because like let's say you know, like audit firm, they might need accountant, okay, and they need company secretary, yeah, so they actually partner. So when the customer hand in the accounts, okay, so there will be accounts department who actually do the double entry, and then can pass to the tax department to calculate the tax. And then they also need company secretary. Yeah, so you have a company secretary there. So it's a convenient, it's like one stop that can help you to count in all your accounts, okay, accounting related things. Right? Okay. Now, so a partnership is basically that you have to share your profit off. But the good thing is when you make loss, also got people share with you lah. Yeah, like that lah. Yeah. Okay. When in terms of tax, okay, individually have to pay tax, just like the sole proprietor is the same. For company, okay, this company is either Sdn Bhd or Berhad. Okay, Sdn Bhd is smaller. Sdn Bhd is normally limited to like family business, and the characteristic is they issue share, but the share they issue share, but the share they do not actually sell to the outsider. You know, the share they issue share also, but the share is not owned by the outsider. It is actually owned by the own family member. Yeah, they don't actually sell the share to outsider. Okay, Berhad is different. Berhad is considered a huge company. They can have 2 million, 3 million, 4 million shareholders because they sell the shares. If you buy the company share, you are the shareholder. Yeah. If you are the shareholder, then you are the owner of the company already. Right? Okay. So for company, for Berhad especially, yeah, the owner of the company, meaning the shareholder, they don't run the company. They don't run the company. Who run the company? They go and appoint somebody, the CEO, the management team to run the company. Yeah, right? Yeah, they don't run the company. So the business is professionally managed by directors, board of directors and management team. So the owner, they don't run the company. They let somebody to run it. But they are the owner. They actually come up with the capital. So shareholders not required to settle the business debt or loan. So if the business not doing well, bankrupt or whatever, the shareholders only lose what they contributed. Meaning, they only let's say I'm interested to invest in this company, so I invested lah. Let's say I invested 10,000. Who knows that after 1 year this company actually bankrupt? So I only lose my 10,000. Yeah. Okay. Now this company bankrupt. Let's say this company bankrupt. Actually, owe a lot of money lah. Owe supplier money lah. Owe the bank lah. It's actually none of my business. Okay, because yeah, none of my business. Yeah, not required to settle. Why? This is what we call limited liability. I only lose the 10,000 that I invested. Okay, I only lose the 10,000 that I invested. Okay, yeah. Right? So the companies have any whatever debt is none of my business. I only lose my 10,000 that I invested earlier on. So this is what we call a limited liability. So profit the company are distributed via dividend. Yeah. So how do you, when the company make money, how do you as a shareholder, the owner, get any share from the company? Okay, through dividend. Yeah, the company will distribute dividend. Yeah, and the company is taxed. Yeah, the company as a whole must pay tax. So meaning, right, for this number 3, this company is just like a person. Yeah, this company is just like a person. Yeah, so you can actually sue this company. Yeah, you can actually sue this company, and this company can own assets. Can borrow money, use the company's name. Okay, yeah. So because you have learned business entity, right? Business entity says the owner's money and the business money you cannot mix on, right? That one business entity normally when we do expansion, we explain using sole proprietorship. Okay, so your accounting cycle again. This is your source document. So we start from source document. This one, the first one, and then we return one cycle. All right. Okay, so that is considered like you've done 1 month accounts or you've done 1 year accounts. So your invoice, credit note, debit note, cash bill, payment voucher, yeah, receipt, official receipt, check counter form. Check counter form is when you issue check, you write, right? And then there's a small part. The small part you record lah. Okay, when you issue to who, for what purpose. It's for your recording so that you can actually record into your 3-column cash book. Yeah, and the memo. Okay, and the 7 books of crime entry. This is your 7 books of crime entry. So you have what? Cash book, petty cash. Cash book is your 3-column cash book. Petty cash, then you have sales journal, purchases journal, return dealer journal, return hours journal, and general journal. So this is what we call 7 books of crime entry. So you have 3 ledger. So you have sales ledger, purchases ledger, and general ledger. Sales ledger is to record all your customers. Purchases ledger is to record all your suppliers. Yeah, all your suppliers. All right. Okay. General ledger will be on other things like your expenses. Okay. Your purchases account, your sales account, your rental account, your rental income account, your commission received account. All these under general ledger. Like your non ledger, if not under purchase ledger, it will be all under general ledger. Yeah. So you just think in this way, so it's easier. So you see here, individual, yeah, individual customer, individual supplier. Okay, so this is your ledger title account. I'm not sure whether they like to test you T account, but actually T account is not difficult. It's just a bit tedious. So like I say, you have debit, you definitely have credit. Yeah. So you always have to, it must be in a pay, debit, credit, debit, credit. Yeah, all right. Okay. Adjustment, this one, I think you haven't really touched on adjustment. Yeah. Okay, basic financial statement, SO, PL, yeah. These are the 5 basic ones, but for your case, you only learn number 1 and number 2. 3, 4, 5 is not in the syllabus. Okay, this is for advanced level. Yeah, right. And okay, so this is the question, right? Statement. Yeah. So this is the format. So you see, if you want to know how does SOPL look like? Okay, SOPL look like this. So basically, you start with sales and then return inwards if you have net sales, cost of goods sold, right? Under cost of goods sold, what do we have? Yeah, so then you get your gross profit. Then only you go to your other income, your expenses, then you have your net profit. So you see, depreciation is your expenses now. Doubtful debts, you learn doubtful debts already, huh? Then you learn bad debts already, right? These two now you know already. Okay. Yeah, depreciation also you already know, right? See, depreciation is also part of the expenses. Okay, so I mean all these stationery, all these you know, right? Okay. So bad debts, doubtful debt is only an estimation. Okay, when we say bad debts, do we pay? No, we don't pay. Just that we receive less, but we are not going to make any payment. Depreciation also, there's no payment. We only an estimation. Okay, yeah. Bad debt is not an estimate now. Bad debt is actually a real amount that we are unable to collect. Yeah, right. Okay, so this one, SRFP. So this is the format of your SRFP. So you start with non-current asset. Okay, and then you have current asset. So you must know how to differentiate between non-current and current. So this is more than 1 year. This is within 1 year. Yeah, see all the prepaid. And then it followed by equity. Equity, which is your income. So you always start with your opening capital. Add profit, less drawing. This is your closing capital, right? And then you have okay. So from here, this question, I know that there is no non-current liability. Yeah, because if you have a non-current liability will be on top of current liability. Yeah, okay, it will be on top of current liability, right? Okay, so statement of cash flow, this one is not in your syllabus, so I'm going to skip this one. Okay, so skip. This one, they only show you the part of it. So this is your chapter 1 now. Right? Okay, then do you have any question on chapter 1?
No.
No.
Chapter 1 now.
Okay, now, yeah, okay, cash cycle. Now, cash cycle is this chapter is important. Cash cycle. Okay, what is so important? 3-column cash flow. Yeah, make sure you know how to do 3-column cash flow. Okay, I think this is the easiest chapter. When you receive money, you put on the debit, when you pay, you put on the credit, right? This format. So make sure you know. Yeah, if you've done your homework, you have format already, so you don't have to worry lah. Later test, right? Remember what is the function of folio? Okay, correct? Yeah, I believe cash book, right? You shouldn't have any issue. This one normally student can do. Just that maybe minor one, right? Like those from cash we bank in, credit, cash, debit, bank. This one maybe sometimes a bit confused, but shouldn't have any problem. Yeah, trade discount. Okay, now this chapter, if I want to test you theory, I'll be interested to test you this one now. What's the difference between trade discount and cash discount? Is there any difference? This one you must know. Okay, please study this one. Okay, what's the difference between trade discount and cash discount? Cash discount, we have discount allowed and discount received. So discount allowed is debit side or credit side? Discount allowed is debit or credit?
Debit.
Yes, discount allowed is debit. Is our expenses. Discount received is credit, is our income. So prove that income is always on the credit. All right, okay. Yeah, so cash book, okay. So you know how to fill up the discount allowed, discount received, right? Okay. Yeah. So if you do homework, this one not a problem at all. And normally what they test you is 3-column cash book. Yeah, 3-column cash book. So again, all the example, all the illustration in your lecture note, please study. Make sure you master them. You understand what is it all about. Right? Okay. Yeah, like this one, capital injection, debit, bank, credit, capital. Yeah. Okay. And we have a withdrawal. What is the double entry? All here, all this you have to know. Petty cash, right? Normally we don't really test you. Petty cash is actually like this. Petty cash is to record, and then they put the analysis on whether is it a stationary or posted in trouble or something. I think this one not that important. For diploma student, maybe yes, but for degree, I think not. Right? So, but it's good that you have an idea. How do you actually record this? Yeah. Okay, and then the general ledger. I see general ledger is the stationary postage trouble. Yeah, all right. When I mark your question, right, for this one, I think somehow when you record, when you do an individual supplier account, individual customer account, make sure you put them together. Like let's say you have customer A and customer B. So when you prepare the ledger account, you put customer and customer B together, and this you label as sales ledger. Like that. Yeah. So in your general ledger, there's no individual supplier or customer account. In your general ledger, what you have is a trade receivable control account. So where you get trade receivable control account amount is actually your individual A plus your individual B. Correct? Yes. So it's actually like that. So I believe cash book, 3-column cash book, most likely they will test you. Most likely. Yeah. So I believe this one you shouldn't have any problem, right? Anyone don't know how to do 3-column cash book? Okay, right? So read your question carefully. Please differentiate between cash and bank. By check. If the question says by check, it will be bank, right? If the question says by check, it will be bank. Yeah, okay. So please differentiate this one. So this one should be all right. Okay, now purchases cycle. Okay, now purchases cycle. This one, purchases cycle is actually okay. Purchases is this one we look at. Okay, we have when we talk about purchases, we can have cash purchases or credit purchases, right? Cash purchases you record in where? Your cash purchases. What is your double entry for cash purchases? Debit?
Debit purchase,
Debit purchases, credit?
credit, cash.
Yeah, credit cash. So meaning if you have a cash purchases, the two account involved is cash account and purchases account. Or 3-column cash book and purchases, right? It's the same, right? Actually, yeah. Correct? Yeah. So purchases is basically okay. Purchases means we buy. Purchases means we buy. But if you put under purchases, meaning you are going to resell. If you do not want to resell, you cannot put as purchase. Or just like if you purchase a motor van. Now, motor van. If you are running a furniture shop, if you buy a lorry, would you treat as purchases? You are running
No.
furniture shop. Yes.
No.
No. So purchases, yeah. Purchases means you buy, but your intention is to resell. That is called purchases, yeah. Okay. So this is very important, yeah. Now, credit purchases means you pay later. Trade discount means the more you buy, the more trade discount I will give you. Correct? The more you buy, the more trade discount you will get. So trade discount is actually because you buy in bulk. And trade discount, okay, trade discount will only appear in purchases journal. Yeah, trade discount only appear in your purchases journal. Correct? Yes. Yeah. Okay. So and remember, when you purchase, there's a trade discount. Okay. When you return, also please don't forget the trade discount. Don't forget the trade discount. This one, a lot of people actually make the mistake. Right? Okay, so your credit purchases, your book of prime entry is purchases journal. Okay, now again, there's an illustration, Okay, so make sure you go and study this one. Okay, so all the answer is here. So this is like become your format. Right? You see all the discount. So when you have a discount, Then when you return also, please make sure you've done the discount, yeah? Okay, now, I want to emphasize, when you prepare purchases journal, so please put down purchases journal, label what you are doing, okay, label what you are doing, purchases journal, okay, then you list down one by one. If there's discount, then you put. Now, at the end, you need to get the total, right? Okay, the total here, and remember this one must put debit. Purchases account debit. This one got marks. Yeah, we will award you marks on this one. So be careful with this one. Yeah, we award you marks on this one. So, okay, remember, must put purchases account debit. All right, okay, so in your first test, okay, most likely you are asked to prepare purchases journal, return outwards journal. Yeah. And they might ask you to do purchases ledger. Purchases ledger is individual, individual, correct? Okay, and then this is your total individual, right? Okay, and this total you are going to put into your then purchases account is actually from your here purchases account is actually from here. See purchases account here, right? Okay, so go and study this illustration. Okay, like this. Now payable control. Payable control is you plus. Let's say you have 3 supplier. You add your supplier A, B, C all plus together. You put into your track payable control account. Yeah. So control account is actually you group all your supplier together. You have 3, group all 3. You have 2, group all 2. Okay. Now return. Return outwards is we buy from our supplier. Now we want to return. So that's why it's out. It's out. So return outwards related to purchases. Yeah. So you recognize from the English words. Then you will remember forever. Okay. Yeah. So again. Make sure you know how to record now. Return outwards again, please put down the title. And this one also important. Yeah, must put down return outwards account credit. That's it. Yeah, must put down credit. Okay, must put down like this and then you put credit. All right, put credit. All right. Okay. Again, purchases ledger. Ledger is individual. And then you have then you have a general ledger. In your general ledger, you have return outwards. Then you have track payable control. This is actually a total. So when you purchase using cash, so like just like I asked you, right? Credit cash, debit purchases. Yeah. Again, this one illustration. Please read and make sure you understand what is it all about. Yeah. Double entry, debit, credit. Right? See, cash, bank. Yeah, this one with discount. This one is when make payment. When we actually pay, see, credit bank, credit discount receipt, meaning we actually pay to our supplier. Yeah, we pay to our supplier. All right. Okay, the cash book. Yeah. So this one, I believe you've done cash book, then you have an idea how you actually get this number. Yeah. Right. So this one you can do like this because this is all your. It's actually these are all your supplier. But in a normal long question, you cannot do this now because you have mix of some expenses that you pay, right? Okay, and then yeah, discount, receive, okay, purchase ledger, yeah. So okay, so your test is only up to purchases, only up to chapter 3, right? So it's the journal. Now, if what happened with if you know how to do chapter 3 is A and B, so meaning including sales cycle also. Now, if you know how to do purchases, you know how to do sales now, right? It's the other way around now. Sales is we sell to our customer. Is that right? It sells to the customer. So same thing, we have cash sales, we have credit sales. So again, remember to put down sales journal. And remember sales account is credit and get the total. All right, track discount. Yeah, okay. So same thing, huh? Just now purchases ledger, now it's sales ledger. So sales ledger is all the individual account. Okay, all the individual account. All right, all the individual account. Yeah, okay. Okay. So do you agree with me? If you know how to do purchases journal, you know how to do sales journal. Isn't it
Yeah.
correct? Yeah.
Purchases
So
all
basically,
purchases all debit and then sales is a credit.
yes, correct. Yeah, purchases account is debit, sales account is on the credit, trade receivable is debit, right? Trade payable is credit, right? Correct, right? So you see, when we purchase on credit, we debit purchases, we credit trade payable. Meaning we haven't paid yet. But if you say you have a cash purchases, you pay, right? So you credit cash, then you debit purchases. So whether on credit or on cash, no matter how, you must debit purchases, right? You realize or not? Now, same goes to yourself. It's the same. When we sell, we can sell on credit. We can have cash sales. If we have cash sales, we debit cash, we credit sales. If we have credit sales, we debit trade receivable with credit sales. So no matter how, we credit sales. Right or not? So somehow you find that accounting very easy, right? Actually, accounting is not difficult. I mean, this what you are doing now is actually bookkeeping. It's actually very simple. Okay, so again, return inwards. Again, this one remember, return inward is debit. You see, because your sales is credit, your return inwards must be debit now. Or else, how do you reduce your sales? Makes sense, right? Yeah. If you put on the same side, meaning both on the credit, both on the credit means it will increase, it will not decrease. So you see the logic. When you want to, if this is a debit account, you want to minus, you want to put on credit side, right? If this is a credit account, if you want to minus, you put on the debit. Yeah, opposite to the opposite, then it will reduce. If you put on the same side, it will increase. Correct or not? Yeah. So this is the very basic idea. Okay? Yeah. So same thing lah. So if you sell, okay, yeah. So you can actually, in fact, your lecture note is very comprehensive. So if you're able to understand, digest the whole lecture note, right, you shouldn't have any problem. You shouldn't have any problem. Okay? So already, kind of like go through everything. So, okay or not? Okay, now, so after your test, okay, then you continue your question, your section B. But anyway, remind me next week to show you the answer. Yeah, remind me next week to show you the answer. Or else, let me see, the next tutorial is very long because sometimes the tutorial is not very long, then we can actually do it. Oh, next week we are going to do inventory. So we try to, if not enough time, then maybe we see how maybe we extend some time. Yeah, but I think you can actually try tutorial 7 section B. Yeah, like I told you, tutorial 7 section B question 1 is this is a very good question to test your understanding. Yeah, question 2 is actually very short. So you can try to do. Yeah, if you hand in, then I mark for you. Oh, Noel, I saw your answer. I need to get my pen tablet fixed. Okay, then I can mark with it later in the afternoon or tonight. Okay, so I will return to you lah. Yeah. So if you have any problem when you do the revision, you can actually text me lah. Okay, then I will reply. All right.
Okay.
Can? Okay. So if okay, then I'm going to see you next week. So all the best in your test, yeah?
Thanks, miss.
Okay.
Okay, thank you.
Okay, no problem. All right. See you then.